The United States government is about to become one of the largest Bitcoin holders on the planet, not as a speculative bet, not as a pilot program, as official national policy, locked in by law, audited every quarter, and untouchable for 20 years. Think about what that sentence actually means for a moment, because if you understand the full weight of what is happening in Washington right now, you will understand why this is not just a Bitcoin story. This is a story about the future of money, the future of national reserves, and the moment when a technology that most governments spent a decade trying to kill became something they are now racing to own. By the end of this video, you will understand exactly what this legislation says, what it changes, why the 20-year lockup is the most important number in the entire bill, and what this means for where Bitcoin goes from here. Because the implications run much deeper than the headline suggests. If you want to understand what is actually happening in this market, not the noise, not the recycled Twitter takes, but the real legislative mechanics, the real supply dynamics, and the real behavior of the largest players on Earth, then this channel is where that analysis lives. Every video goes deeper than the surface. Hit subscribe and make sure the bell is on so you don't miss what comes next. And if this gives you something the rest of the internet isn't giving you, the like button tells the algorithm that more people need to see this. Now let's go. Here's what is actually happening. The American Reserve Modernization Act of 2026, known as ARMA, was introduced by Congressman Nick Begich of Alaska, alongside co-lead Congressman Jared Golden of Maine, with more than 20 bipartisan co-sponsors. The bill directs the United States Treasury to actively accumulate up to 1 million Bitcoin over a 5-year period, representing approximately 5% of the total supply that will ever exist. That Bitcoin must then be held for a minimum of 20 years and may only be sold for one specific purpose: to reduce the national debt. The full legislative text has now been published on congress.gov, revealing a mandatory quarterly proof of reserve reporting requirement, published on an official Treasury website, audited publicly. Treasury Secretary Scott Bessent has publicly backed the reserve, stating the administration is proceeding with all deliberate speed and using best practices to ensure the framework is durable for the future. The executive order establishing the Strategic Bitcoin Reserve was signed in March 2025. ARMA is the bill that transforms that executive order into permanent law. Now, on the surface, this looks like a political statement, a pro-crypto administration making a symbolic gesture toward an asset its base loves. That is the shallow reading. Here is where the data starts to tell a very different story. But to understand it, you need to understand what the government actually already holds, and what the bill's mechanics actually do to the available supply of Bitcoin. The United States government currently holds an estimated 328,000 Bitcoin, acquired almost entirely through criminal and civil asset forfeiture proceedings. The bill codifies this existing stockpile into the reserve, adds a mechanism to acquire up to 1 million Bitcoin total, and then locks every single coin for 2 decades. When you combine that with the Bitcoin already held by publicly traded corporations, MicroStrategy alone holds over 500,000 coins, and the institutional accumulation flowing through Bitcoin ETFs, you begin to understand what this bill actually does. It removes a colossal amount of Bitcoin from the liquid market, not gradually, not hypothetically, by law. And here's the question no one in the mainstream media is asking. What happens to the price of any asset when the largest economy in the world commits to buying 5% of its total supply, while simultaneously passing legislation that makes selling it illegal for 20 years? The crowd right now is focused on the political narrative. Is this real? Will it pass? What do Democrats think? These are the wrong questions. The right question is about supply and demand arithmetic. And right now, that arithmetic is moving in one direction only. Let's talk about the psychology driving market behavior in the immediate aftermath of this news, because it tells you something important about where we are in the cycle. Retail sentiment right now is a mixture of excitement and disbelief. You can see it in social media engagement patterns, in the search volume spikes, and in the way smaller wallets have been rotating back into Bitcoin over the last several weeks. That combination, emotional excitement with a layer of skepticism, is actually a healthy setup. It is not the euphoria of a market top. It is the hesitant optimism of a market that does not fully believe what it is seeing yet. The dangerous psychology would be unanimous celebration. It is not there, and that matters. Meanwhile, the behavior of large wallet addresses, the entities holding 1,000 or more Bitcoin, tells a completely different story. Exchange reserves have been declining for months. Coins are moving off trading platforms and into cold storage at a pace that has historically preceded significant price appreciation. When large holders pull coins off exchanges, they are signaling one thing. They are not planning to sell. They are planning to wait. The divergence between retail hesitation and large holder accumulation is one of the most consistent bullish signals in Bitcoin's history. The crowd is questioning. Smart money is positioning. Stay with me because this historical context changes everything about how you should interpret what is happening right now. The closest structural parallel to this moment is not 2017. It is not 2021. The closest parallel is actually the period between late 2012 and early 2013, when the Bitcoin ecosystem crossed an invisible threshold, the point at which enough serious, well-capitalized participants had decided that Bitcoin was worth holding rather than speculating on. In 2012, the signal was smaller exchanges gaining traction and early venture capital entering the space. The price of Bitcoin in October 2012 was around $13. 12 months later, it was over $1,000. The catalyst was not a single event. It was the slow, irreversible recognition by serious players that the supply was fixed and the demand was growing. What ARMA represents is a structurally similar threshold, except the players recognizing that supply is finite are not venture capitalists. They are sovereign governments. And the scale is not millions of dollars. It is trillions in fiscal and monetary policy machinery being redirected toward a 21 million coin asset. The second historical comparison to keep in mind is more cautionary, and it is one that most Bitcoin bulls do not want to hear. In 2021, institutional enthusiasm drove Bitcoin from roughly $30,000 to nearly $69,000 in under a year. Then, over the following 12 months, it collapsed by more than 75%. The mechanism was not a loss of fundamentals. The fundamentals were stronger in 2022 than in 2020. The mechanism was over-leveraged speculation building on top of genuine adoption. And when the leverage unwound, the genuine adoption did not save the price in the short term. Legislative excitement can create a similar dynamic. If the ARMA news drives speculative leverage into the market faster than the actual supply effects materialize, the setup for a sharp correction builds even as the long-term thesis strengthens. Now, this is where the data becomes extremely important. On-chain metrics are currently painting a picture that experienced analysts recognize. Exchange reserves, the total number of Bitcoin sitting on trading platforms available for immediate sale, have been trending downward for over a year. This is significant because when coins leave exchanges, they are effectively leaving the liquid market. They are entering cold storage, corporate treasuries, ETF custodians, and now, increasingly, government vaults. The liquid float of Bitcoin, the coins that are actually available to be bought or sold at any given moment, is shrinking even as demand accelerates. The MV/RV ratio, which measures the relationship between Bitcoin's current market value and the aggregate cost basis of all existing coins, is currently sitting in a zone that has historically indicated either a strong continuation phase or a local top, depending on the direction of momentum. Right now, momentum is constructive, meaning the bias in that ambiguous zone is toward continuation, not reversal. But it is worth watching because if sentiment overshoots and the ratio climbs above 3.5, that has marked distribution zones in every prior cycle. The stock-to-flow supply dynamic adds another layer. Post-halving, Bitcoin's annual new supply issuance is now lower than gold's annual mine production as a percentage of total existing supply. Combined with government acquisition mandates, corporate treasury accumulation, and ETF inflows, the demand-side pressure on a shrinking liquid supply creates conditions that have no direct historical precedent. The real story is happening underneath the surface, and it connects directly to the macro environment that Bitcoin now exists inside. The Federal Reserve is navigating one of the most complex monetary policy environments in modern history. The national debt has crossed $36 trillion. Debt service costs are consuming an increasingly large share of the federal budget. The political pressure to inflate that debt away, to allow real interest rates to remain negative over time, is not a conspiracy theory. It is basic fiscal arithmetic. And it is precisely the environment that Bitcoin's fixed supply was designed to exist in. The dollar has shown structural weakness against a basket of currencies over the past 18 months. When the dollar weakens, dollar-denominated hard assets tend to appreciate in price terms. Gold has already reflected this dynamic, reaching new all-time highs. Bitcoin's correlation with gold during genuine macro stress periods, as opposed to speculative risk-on rallies, has been strengthening. The global money supply has grown by more than 40% since 2020. The total supply of Bitcoin has grown by less than 5% in the same period. This is not a talking point. It is arithmetic. And the ARMA bill is the United States government acknowledging, in legislative language, that they understand this arithmetic. Now let's talk about the strongest version of the bull case, because it is genuinely strong and it deserves to be stated clearly. If ARMA passes into law and Treasury begins actively acquiring Bitcoin on the open market, the supply shock will be unlike anything this asset has experienced. The US government buying 1 million coins at current prices represents over $80 billion in purchasing pressure entering the market over 5 years. Simultaneously, the 20-year lockup provision removes those coins from the liquid supply permanently for the foreseeable future. Other nations, and this is the part the mainstream media is not covering adequately, will face a choice. Do they watch the United States accumulate a dominant position in the world's hardest asset, or do they begin their own reserve programs? China, Russia, and several Gulf states have already been quietly accumulating Bitcoin for years. A formal U.S. reserve mandate changes the geopolitical calculus entirely. This could trigger a sovereign accumulation race that makes corporate treasury adoption look trivial by comparison. In a world where multiple sovereign wealth funds and central banks are competing to accumulate a fixed supply asset, the price discovery mechanism does not look like prior cycles. It looks like something new. But here is the bear case, and it deserves equal weight. ARMA is currently in the House Financial Services Committee. It has not been voted on. It has not cleared the Senate. Legislative timelines in Washington are measured in months and years, not weeks. The bill's budget-neutral funding mechanism, which relies on revaluing the Federal Reserve's gold certificates to current market prices, is creative, but it is not guaranteed to survive the political process intact. There are serious fiscal conservatives in both parties who will challenge whether this mechanism actually avoids adding to the national debt. If the funding mechanism is stripped or restructured, the acquisition target of 1 million Bitcoin becomes much harder to achieve on the stated timeline. Additionally, the very excitement this news has generated can become a liability. Retail speculation flowing into a market on legislative hope before any actual buying has occurred creates a setup where the news is already priced in before the policy is implemented. If there is any delay, any political obstacle, or any softening of the bill's terms, the speculative premium that has built into the price becomes a source of selling pressure, not a floor. The real story is not whether this bill passes exactly as written. It is whether the direction of travel it represents is irreversible. And that is a question with a more interesting answer. In the next 30 to 60 days, there are 3 specific developments that will tell you which of these scenarios is actually unfolding. The first is whether ARMA receives a committee markup date in the House Financial Services Committee, because a markup date signals genuine legislative momentum, not just symbolic co-sponsorship. The second is the behavior of exchange reserves in response to the news. If the institutional reaction is to accumulate further, which shows up as continued outflows from exchange wallets, that confirms the smart money sees this as real, not performative. And the third is the trajectory of the Clarity Act, the digital asset market structure bill that cleared the Senate Banking Committee in a 15-9 vote in May. Bessent has linked support for the reserve explicitly to this broader regulatory framework. If Clarity advances to a Senate floor vote before the end of the summer, it signals that the legislative environment is genuinely opening, not just for the reserve, but for the entire institutional adoption thesis. Watch those 3 signals, not the price, not social media sentiment, the signals. Here is the thing about what is happening right now that most people will miss because they are too focused on the price chart. The United States government passing a law to buy and hold Bitcoin is not just a Bitcoin event. It is a statement about the nature of money. Gold became the global reserve standard not because governments loved gold. They were often forced into it by market reality, by the arithmetic of trust and scarcity. What we are watching in real time is the early stages of a similar process playing out with Bitcoin. Not because politicians are visionaries, because the math is becoming impossible to ignore. Every Bitcoin that enters a government vault under a 20-year lockup is a Bitcoin that can never be sold into a panic. It is permanent demand meeting permanent scarcity. And once one major sovereign sets that precedent, the competitive logic for every other sovereign is clear. The question I want to leave you with is this. Do you believe that sovereign governments accumulating Bitcoin accelerates the timeline of Bitcoin becoming a global reserve asset? Or does government involvement fundamentally change the decentralized nature of what Bitcoin was supposed to be? This is not a rhetorical question. It is the most important philosophical debate in this space right now. Let me know exactly what you think in the comments below.